We now proceed to the topic on return of income. So there are various provisions relating to return of income, and these are contained in section 139. We first look at the regular return of income, section 139.1. Who is required to file return of income under 139.1? There are 5 categories A, B, C, D, E. So a person falling under A or B or C or D or E is required to furnish a return of income. Category A company or a firm is required to furnish return of income under 139.1 in all cases. Category B, an individual HUF, AOP, BOI or artificial juridical person is required to furnish return of income if the total income for the previous year is more than the basic exemption limit. And total income for this purpose is without giving effect to the specified exemptions and deductions. What are the specified exemptions and deductions? 1. Capital gain exemption under section 54, 54B, 54D, 54EC, 54F, 54G, 54GA, 54GB. Right? 54G, 54GA and GB are not relevant for CA intermediate. We have discussed 54, 54B, D, EC and F in the topic on capital gains. Second, the deduction under chapter VIA from the gross total income. So total income will be arrived at after providing these capital gains exemptions if available and deductions under chapter VIA, right? In that case, we need to add them back. So that gives us the total income for figuring out whether return of income is required to be furnished or not. So if such total income which is adjusted on this count is more than the basic exemption limit, then return is required to be furnished. Category C, a person who is other than that referred in categories A and B is required to furnish return if the total income for the previous year is greater than basic exemption limit. Category D, a person who is not required to furnish a return under categories B and C is still required to furnish a return of income if he fulfills any of the following 7 criteria during the previous year. Criteria 1. He has deposited more than rupees 1 crore in current accounts with a bank or a cooperative bank during the previous year. Criteria 2. He has incurred expenditure of more than rupees 2 lakh on travel to a foreign country for himself or any other person. Criteria 3. He has incurred expenditure of more than rupees 1 lakh on consumption of electricity. Criteria 4. His total sales, turnover or gross receipts, as the case may be in the business, is more than rupees 60 lakh during the previous year. Criteria 5. His total gross receipts in profession is more than rupees 10 lakh during the previous year. Criteria 6. The aggregate of TDS deducted and TCS collected during the previous year in his case is not less than rupees 25,000. That is rupees 25,000 or more. This threshold is rupees 50,000 in case of a senior citizen. Criteria 7. The deposit in one or more savings bank account. That means he has deposited not less than rupees 50 lakh. That means rupees 50 lakh or more in his savings bank account during the previous year. If any of these 7 criteria are fulfilled, then the person is required to furnish return of income even if he is otherwise not required to furnish under categories B or C. In category A, of course, company or a firm is always required to furnish return of income. Who is a senior citizen? An individual resident in India who is of the age of 60 years or more when at any time during the relevant previous year. Now, if a person is not required to furnish a return of income under the categories that we have discussed so far, then he is still required to furnish a return if he is a resident but not a RNOR. That means he is a resident and ordinarily resident, ROR. Okay. If he at any time during the previous year fulfills any of the following criteria 1 or 2. Criteria 1. He holds asset located outside India. That is, he holds a foreign asset. as a beneficial owner or otherwise, or he has a signing authority in any account located outside India. This is criteria 1. Criteria 2, he is a beneficiary of any foreign asset, that is any asset located outside India. In that case, such person needs to furnish a return of income. Now in this category E, when we talk about asset located outside India, it includes any financial interest in any entity also. Recollect section 194P in the context of TDS, meant for specified senior citizen, in which case we looked that provisions of section 139 do not apply to such specified senior citizen, so such person is not required to furnish return of income. Now once a person is supposed to furnish a return of income, he should do that on or before the due date is specified under section 139(1). And there are 3 due dates which have been specified: 30th November, 31st October and 31st July of the assessment year. What is the due date? It depends on the category of SSE. And there are 3 categories, 1, 2 and 3. Category 1 covers an SSE who is required to furnish a transfer pricing report under section 92E. Section 92E is not relevant for CA intermediate syllabus, but due dates are relevant to note. So there are 3 kinds of persons who are covered in this category. Such SSE, that means who is required to furnish a TP report, or if such SSE is a firm, then the partners of the firm. And thirdly, the spouse of such partner of the firm who is supposed to furnish a TP report. The spouse of such partner is also covered if section 5A applies to such spouse. What is section 5A? It deals with the apportionment of income between spouses governed by Portuguese Civil Code. This is not a part of CA intermediate syllabus. Now in each of these cases covered in category 1, the due date is 30th of November of the assessment year. Category 2 refers to an SSE who is not covered under category 1. That means an SSE who is not required to furnish a TP report. And there are 4 cases here. Number 1, in the case of a company. Second, in the case of a person who is other than a company, that means a non-company, whose accounts are required to be audited under the Income Tax Act, like tax audit under section 44AB or under any other law. Third, a partner of a firm whose accounts are so required to be audited. Fourth, the spouse of a partner covered here, but if section 5A applies to such a spouse. Okay. In these 4 cases, the due date to furnish return of income under 139(1) is 31st October of the assessment year. And category 3 is the residual category, where the SSE is not covered under category 1 and category 2. In such case, the due date is 31st July of the assessment year. This is about return of income under section 139(1). Now we will look at certain other categories of return. Return of loss is covered by section 139(3). Recollect our discussion in the topic on set off and carry forward of losses, where we noted that certain losses cannot be carried forward unless they are determined in pursuance of a return of loss filed in accordance with section 139(3) within the time allowed under section 139(1). Okay, this is return of loss. And all provisions of the Act apply as if such return were a return under section 139(1). So a return of loss which is filed within the time allowed under 139(1) is treated as a return under section 139(1) for all provisions of the Act. Next is belated return. This is section 139(4). Any person who has not furnished a return within the time allowed under section 139(1), 31st July or 31st October or by 30th of November, can furnish a belated return at any time before the earlier of A, 3 months prior to the end of the relevant assessment year, which means 31st December, or completion of the assessment. Revised return is covered under section 139(5). This provides that if any person has furnished a regular return under 139(1) or a belated return under 139(4), and then such person discovers any omission or any wrong statement in such return, then he can furnish a revised return. When? at any time before the earlier of 1 or 2. 1, 3 months prior to the end of the relevant assessment year, that is 31st of December, or 2, completion of assessment. So the time limit to furnish belated as well as a revised return is the same. Practically, it is 31st of December of the assessment year, because completion of the assessment almost in all cases takes place after this date. Now, certain types of return, whether they can be revised under 139.5. Regular return of income under 139.1 can be revised under 139.5. What about return of loss under 139.3? Yes, it can be revised if it was filed within the time allowed under section 139.1, since, as we noted above, such return is treated as a return under section 139.1. What about belated return under 139.4? Yes, it can be revised. What about a defective return under 139.9? Yes, it can be revised if it is rectified within the time allowed under 139.9. Section 139.8a provides for furnishing of an updated return. Who can furnish an updated return? So any person can furnish an updated return of income for an assessment year, whether or not the person has furnished a regular return under 139.1 or a belated return under 139.4 or a revised return under 139.5. So if a regular or belated or revised return has been furnished, the person can furnish an updated return of income. If no return has been furnished so far, then also the person can furnish an updated return, which will be the first return furnished by the person for that assessment year. What is the time limit? Updated return can be furnished at any time within 24 months from the end of the relevant assessment year. So if previous year is 2022-23, the assessment year will be 2023-24, and 2 years, that is 24 months from the end of the relevant assessment year, 31st March 2026. Till this date, updated return can be furnished in respect of assessment year 2023-24. Exclusions. Provisions of updated return do not apply in the following cases, so updated return cannot be furnished. 1. If updated return is a return of a loss for the relevant assessment year, so updated return cannot be a return of loss. See, the whole idea behind these exclusions is to ensure that the government doesn't lose out on its revenue on account of furnishing of updated return. Second, if updated return has the effect of decreasing the total tax liability determined on the basis of return furnished earlier, that is the regular return or belated return or revised return. So if the updated return cannot decrease the tax liability compared to what has been declared earlier. Third, the updated return should not result in a refund, and it should not increase the refund due compared to what has been the position under the regular return or belated return or revised return for the relevant assessment year. Ineligibility. An updated return cannot be furnished in the following cases. 1. Where an updated return has already been furnished. This means that an updated return cannot again be updated. Second, where any proceeding for assessment or reassessment or recomputation or revision of income is either pending or has been completed for the relevant assessment year in this case. So if these proceedings have been initiated, then updated return cannot be furnished, because finality needs to be achieved at some point of time and things cannot go on endlessly. Third, in case of notified persons have not been notified so far. What if the person had furnished a return of loss within the time allowed under section 139.1? Can updated return be furnished in such case? Yes, updated return can be furnished. The condition is that updated return should be a return of income. There can be a situation, say this is previous year 1 and this is previous year 2. There was an unabsorbed loss in previous year 1 which was then carried forward to previous year 2. Now say updated return is furnished for previous year 1, because of which the loss is reduced, and consequently the loss which needs to be carried forward to year 2 is also reduced. Now since the updated return has been furnished in previous year 1 and the loss which has been carried forward to previous year 2 is also reduced, then consequently updated return will also need to be furnished for previous year 2 as well. So what do the provision says? If there is a loss or unabsorbed depreciation or AMT credit which is carried forward, and that is to be reduced for any subsequent previous year, okay, as a result of what? Furnishing of updated return of income for a previous year, then updated return is not only to be furnished for that previous year but also for each subsequent previous years. This is the effect. Now we come to the provisions of defective return, and this is provided by section 139.9. Now the return is regarded as defective unless all the specified conditions are fulfilled. There is a list of specified conditions, and if any of those conditions is not fulfilled, then the return is regarded as defective. In that case, the AO may intimate the defect to the SSE and give him an opportunity to rectify the defect within a time limit of 15 days, which can be extended in his discretion. If the SSE fails to rectify the defect within this time period, the return is treated as invalid and the provisions of Act apply as if the SSE had failed to furnish the return, as if the return was not furnished at all. The return needs to be verified in accordance with section 140. If return is not verified, it is invalid. Okay, that means it is taken as if the return was not furnished. So verification of return is very important. Who should verify the return? In the case of an individual, by default, the individual himself should verify the return. Where the individual is absent from India, the individual himself can verify, or an authorized person can verify who holds a valid power of attorney which should be attached to the return. Where the individual is mentally incapacitated from attending to his affairs, then the guardian should verify or any other person competent to act on his behalf. Where for any other reason it is not possible for the individual to verify, then an authorized person can verify who holds a valid power of attorney which should be attached to the return. In the case of HUF, by default, the Karta needs to verify. But where the Karta is absent from India, then any other adult member can verify, not a minor member. Where the Karta is mentally incapacitated, in that case also any other adult member can verify. In the case of a company, by default, the managing director should verify the return. But where for any unavoidable reason the managing director is not able to verify, then any director of the company or any person who is prescribed can verify. The person prescribed is basically the person appointed by the adjudicating authority for discharging the duties and functions of an interim resolution professional, a resolution professional or a liquidator under the Insolvency and Bankruptcy Code 2016. So in such case, such prescribed person can verify the return. Where there is no managing director, then any director or any person prescribed can verify. Now where the company is not resident in India, then a person who holds a valid power of attorney can verify the return and the power of attorney should be attached to the return. Where the company is being wound up or where any person has been appointed as the receiver, then the liquidator can verify. Where management has been taken over by the government, whether central or state government, then the principal officer can verify. Where the application for corporate insolvency resolution process has been admitted under the IBC, that is Insolvency and Bankruptcy Code, then the insolvency professional who is appointed by the adjudicating authority can verify the return of the company. In case of a firm, by default, the managing partner needs to verify. But if for any unavoidable reason the managing partner is not able to verify, then any partner not being a minor can verify. And where there is no managing partner as such, in that case also any partner not being a minor can verify. In case of LLP, by default it is the designated partner. But where for any unavoidable reason the designated partner is not able to verify, then any partner or any other prescribed person that we have noted some time back can verify. And the same position applies where there is no designated partner as such. What about a local authority? The principal officer is the person to verify the return by default. In the case of political party, the CEO of the political party, Chief Executive Officer. In the case of any other association, any member or principal officer. And in the case of any other person not covered above, that person himself or by some person who is competent to act on his behalf. So these are the persons who can verify the return under section 140. Now there is a scheme under which, and this is section 139B, this is a TRP scheme. There is a scheme under which an individual or HUF can furnish his return after getting it prepared through a TRP. So the return can be prepared by a TRP in the case of an individual or HUF, and this is at the option of such individual or HUF. This is optional. But there are two cases where the person cannot furnish the return through a TRP. Number one, a person carrying out business or profession during the relevant previous year whose accounts are required to be audited under 44AB or under any other law. So in tax audit cases, the return cannot be prepared by a TRP. Number two, if a person is not resident in India during the relevant previous year, then that person cannot get his return prepared by a TRP. Who is a TRP? TRP can be an individual, but there are four classes where the person or the individual cannot be a TRP. Number one, an officer of a bank. An officer of a bank with which the SSE maintains a current account or has other regular dealings. Number two, any legal practitioner. Number three, an accountant. And number four, an employee of the specified class of persons who has been authorized to act as a TRP under the scheme. What about a revised return? Can a revised return be furnished through a TRP? It cannot be furnished unless the original return was also furnished through a TRP. We will now cover the provisions for PAN and Aadhaar. Permanent account number of PAN. If the person falls in any of these five categories, then he needs to make an application for allotment of PAN if the PAN has not yet been allotted to such person. Number one, if the total income during any financial year exceeded the basic exemption limit, the time limit to apply is on or before 31st May of the assessment year. If the case is not covered here, that means if the total income did not exceed the basic exemption limit, but the person is carrying on a business or profession, and the total sales turnover or gross receipts are or is likely to exceed rupees 5 lakh in any financial year, then PAN needs to be applied for before the end of that financial year. Third, in the case of a resident not being an individual, if a resident enters into a financial transaction of an amount of 2.5 lakh or more in a financial year, of an amount aggregating to 2.5 lakh in a financial year, then PAN needs to be applied for on or before 31st May following such financial year. PAN also needs to be applied for by the managing director, director, partner, trustee, author, founder, karta, CEO, principal officer or office bearer of such person, or any person competent to act on behalf of such person. Okay, PAN needs to be applied for by such person also, and the time limit is the same as for the resident who is entering into financial transaction of 2.5 lakh or more in the financial year. And finally, a person who intends to enter into the following transaction 1, 2 or 3. 1. Cash deposits aggregating to 20 lakh or more in one or more accounts with a bank or a post office. 2. Cash withdrawals aggregating to 20 lakh or more in one or more accounts with a bank or a post office. 3. Opening of a current account with a bank or a post office, or cash credit account with a bank or a post office. In these cases, 1 or 2 or 3, the person is supposed to apply for PAN at least 7 days before the date on which he intends to enter into such transaction. Now, PAN needs to be quoted by every person in the following. Number 1, in all his returns to the income tax authority or correspondence with the income tax authority or challans for payment of any sum under the act, or in all documents pertaining to the following transactions entered into by the person. So PAN needs to be quoted in all the related documents pertaining to the following transactions. What are these transactions? In the case of transactions number 1 to 4, PAN is supposed to be quoted in respect of all such transactions in the related documents. 1. Sale or purchase of motor vehicle or a vehicle which requires a registration under the Motor Vehicles Act, but other than two-wheelers. Second, opening of an account with a bank, but this does not include time deposit and a savings bank account. Third, where application is made for issue of credit card or debit card in the case of opening of demat account. In these transactions, PAN needs to be quoted in the related documents. In the transactions 5 and 6, PAN needs to be quoted if the payment in cash is of more than 50,000. Payment to a hotel or restaurant against a bill or bills at any one time. Payment in connection with travel to a foreign country, or payment for purchase of any foreign currency at any one time. So in these cases 5 and 6, PAN is supposed to be quoted in related documents if payment in cash is of more than 50,000. Transactions 7, 8 and 9. PAN is to be quoted where the amount is more than 50,000. Payment to a mutual fund for purchase of units. Payment for acquiring debentures or bonds issued by a company or institution. Payment to RBI for acquiring its bonds, RBI bonds. So amount should be more than 50,000. In case of deposit with a bank or post office, PAN is to be quoted if it is a case of cash deposits more than 50,000 during any one day. If the bank draft or pay order or banker's check is being purchased from a bank, then PAN is to be quoted if payment is in cash for more than 50,000 during any one day. If a time deposit is being made with a bank or a post office or a Nidhi or NBFC, in that case PAN is to be quoted if amount is either more than 50,000 or it aggregates to more than 5 lakh during a financial year. If the payment is to a bank or company or institution for what? For a prepaid payment instrument. For example, say a prepaid shopping card. Then PAN is to be quoted if payment is of more than 50,000 in a financial year. And the payment, what is included? It can be by cash or bank draft or pay order or banker's check. If life insurance premium is paid to an insurer, then PAN is to be quoted if amount aggregates to more than 50,000 in a financial year. What about sale or purchase of securities, not being shares, or sale of purchase of unlisted shares? If it is a case of shares, then it should be unlisted shares, or otherwise it should be sale or purchase of securities, okay, not being shares. Then in such case, in both these cases, PAN is to be quoted if the amount is more than 1 lakh per transaction. In case of sale of purchase of immovable property, that is land or building, PAN is to be quoted if either the amount is more than 10 lakh or the SDV is more than 10 lakh. And finally, in the case of sale of purchase of any goods or services of any nature, okay, which is other than what we have discussed in the table so far, then PAN is to be quoted if amount is more than 2 lakh per transaction. We now look at the provisions for quoting of Aadhaar number. Quoting Aadhaar is required, and this applies to a person who is eligible to obtain Aadhaar. Such person is required to quote Aadhaar number. In what? In the application form for allotment of PAN and in the return of income. There are provisions requiring Aadhaar PAN linking. This applies to a person who has been allotted PAN as on 1st July 2017 and who is eligible to obtain Aadhaar number. Such person is required to intimate his Aadhaar number to the tax authority on or before the date of 31st March 2022. In case of failure, following consequences arise. 1. The PAN becomes inoperative immediately after 31st March 2022. That means on and from 1st April 2022. For what purpose? For the purposes of furnishing, intimating or quoting of PAN. And where such person is then required to furnish, intimate or quote the PAN under the provisions of the Act, then it is deemed that he that he has not done so because the PAN has become inoperative and therefore he becomes liable for the consequences. Now, when the person subsequently intimates his Aadhaar, that means after this date of 31st March 2022, then fee is payable under section 234H, which is rupees 500 if the intimation is made within 3 months from 31st March 2022. That means till 30th June 2022. After that, if intimation is made, then the fees is increased to rupees 1000. Now, when the Aadhaar is subsequently intimated, the PAN becomes operative from the date of such intimation. And then the restriction that we noted in serial number 2 above ceases from this date, from when the PAN becomes operative once again. Provisions above regarding quoting of Aadhaar and Aadhaar PAN linking do not apply. So there is an exemption to an individual who does not possess Aadhaar number, and such individual is residing in the states of Assam, Jammu and Kashmir and Meghalaya, a non-resident of the age of 80 years or more at any time during the previous year, not a citizen of India. In such case, exemption has been provided. Now we looked at implication number 2 above in the case of Aadhaar PAN linking, that PAN becomes inoperative and therefore the person, even if he is required to furnish, intimate or quote his PAN, it is treated as if he has not done so and therefore consequences follow for such default. So a one-time window has been provided. 31st March 2022 is the last date for intimating, and then the implication starts to kick in from 1st April 2022. But as per this one-time window, the implication shall now come into effect from 1st April 2023. One more year has been granted. So that means that PAN will continue to be functional till 31st March 2023. But what about fees under section 234H? Payable at the time of intimating Aadhaar, it will continue to be payable. It will continue to be payable. That is rupees 500 up to 30th of June and rupees 1000 after that. Right? And PAN will also continue to be functional. But from 1st April 2023, PAN would become inoperative with all its consequences. Now, what are the consequences of late filing or not filing of return? 1. Interest is payable for default in furnishing return, section 234A. Fees is payable for default in furnishing return, section 234F. Certain losses cannot be carried forward unless return of loss is filed within the time allowed under section 139(1), section 80 and section 139(3). The deductions under certain sections cannot be claimed from the gross total income under chapter VIA. We have noted in the topic on chapter VIA the deductions from gross total income, section 80 JJAA, 80 QQB and 80 RRB. Higher rate of TDS and TCS applies for non-filers. We have noted section 206AB for TDS and 206CCA for TCS. And higher rate of TDS applies for ROI defaulter in the case of cash withdrawal. We have noted this in section 194N in the topic on TDS. Now we look at section 234A, which provides for interest for default in furnishing of return, where the return of income is furnished after the due date or is not furnished. In that case, simple interest is payable. And what is the rate? 1% per month or part of a month. Right? And interest is payable from what date? From point A. Point A is what? The date immediately following the due date of furnishing return under 139(1). Okay? So immediately after that, interest starts to be levied. And this runs till what point of time? There are two situations possible. Where the return is furnished, in that case it is point B, which is date of furnishing of the return. Okay, that is where the return is furnished after the due date, the interest is levied from point A to point B. But if say the return has not been furnished at all, where no return is furnished, then best judgment assessment can be made under section 144 by the assessing officer. In that case, interest runs from point A to point C, which is the date of completion of the best judgment assessment. Now, what is the amount on which interest is computed? It is the shortfall. And what is meant by shortfall? Tax on the total income. This total income. determined upon processing of return or under a regular assessment. And we reduce 1, 2, 3, 4. 1. The advance tax paid. 2. The TDS deducted or TCS collected. 3. Relief under section 89. And 4. AMT credit under 115 JD. So this becomes the shortfall on which interest is computed. Now in the case of self-assessment, that is, the interest will be payable at the time of self-assessment before furnishing of return by the assessee, right? And where the interest is payable at the time of self-assessment, the shortfall will be computed on the basis of what? On the basis of tax on total income as declared in the return, less the following 1, 2, 3, 4. And accordingly, interest under section 234A will be paid at the time of self-assessment. Now for computing interest, fraction of a month is taken as full month. So it is rounded off. Amount on which interest is calculated is also rounded off to the nearest multiple of rupees 100, and for this purpose fraction of rupees 100 is ignored. Apart from interest under 234A, fees is payable for default in furnishing return under section 234F, where a person who is required to furnish return fails to do so within the time prescribed under 139(1). What is the amount of fees? It is 5,000 rupees. But if the total income is not more than rupees 5 lakh, it is not more than rupees 5 lakh, then the fees payable cannot exceed rupees 1,000. So it remains 1,000. If the total income is more than rupees 5 lakh, then the fees under 234F is rupees 5,000. Self-assessment is covered under section 140A, and we have been referring to this term in certain previous topics. So when the assessee furnishes return, before furnishing the return, the assessee is liable to pay tax due with interest as well as the fees. And this is called self-assessment tax because it is payable on self-assessment basis. How do we compute this? We figure out the tax payable on the basis of the return, and then we make certain deductions. Those are tax which has already been paid under any provision of the Act, like advance tax or otherwise, TDS, TCS which is deducted or collected, relief under 89 and AMT credit under 115 JD. And then we arrive at the amount of tax payable, to which we add interest under section 234A for default in furnishing return, 234B for default in payment of advance tax or deferment of payment of advance tax, section 234C. And we add fees under section 234F if any. And the total is the amount payable on self-assessment. Now there may be a case where the assessee does not pay the entire amount payable on self-assessment. So there is a short payment. In that case, how will the amount paid be adjusted? It will be adjusted in the following order. First, it will be adjusted against fees payable 234F, then against interest payable 234ABC, and then finally against tax payable. Finally, we look at section 140B, which provides for tax on updated return. So recollect our discussion on furnishing of updated return short time back under section 139(8)(a). Now where such updated return is furnished by the assessee, he should pay the following amounts before furnishing the updated return. And the updated return is regarded as defective. Recollect our discussion on defective return under 139(9). Updated return is regarded as defective if it is not accompanied by proof of such payment. Okay, so the following amounts need to be paid before furnishing of updated return, and there are three amounts. 1. The tax which will become payable on the basis of updated return. 2nd, interest and fees will become payable on account of 234ABC, right? Interest under 234ABC and fees under 234F. And 3rd, additional income tax also needs to be paid. Now, how to compute these amounts that are supposed to be paid before furnishing of updated return? Two situations can arise. Situation 1, where an earlier return, that means either a regular or belated return, has not been furnished. This means that updated return is the first return for the assessment year which the assessee is furnishing. In that case, we begin with the tax on total income declared in the updated return. and then we reduce the following amounts, which are in the nature of prepaid taxes and certain reliefs, right? What are these? Tax, if any, which is already paid as advance tax. So we reduce advance tax. We reduce TDS or TCS, which is deducted or collected. Relief claimed under 89 and AMT credit allowed under 115 JD. And that gives us the tax payable on the basis of the updated return. To this, we add interest under sections 234A, 234B and 234C, and we add fees payable under 234F. We also add additional income tax. We will look at this in some time. And then what we get is the amount payable before furnishing the updated return. Situation 2 is a situation where an earlier return has been furnished. A regular, belated or revised return has been furnished and now an updated return is being furnished. So we pick up the tax on total income declared in the updated return, and there are certain amounts that we now reduce. First is, so we would have, the SSE would have paid self-assessment tax at the time of furnishing the earlier return and would have taken the credit in terms of relief or tax under section 140A, that is self-assessment tax at that time, right? So as we noted, the provisions of self-assessment tax, the SSE would have taken the credit of all these amounts. The amount of relief or tax, which is referred to under section 140A, needs to be reduced, for which the credit has been taken in the earlier return. So we reduce that. We further reduce TDS deducted or TCS collected on the additional income which is now being declared in the updated return. That means on income which has not been included in the earlier return. Okay. We further reduce AMT credit, if any, under section 115 JD, which was not claimed in the earlier return. So basically these are the incremental amounts which now we reduce further from the tax on the total income declared in the updated return. Now if a refund has been issued in respect of the earlier return, we need to add it. And this gives us the amount of tax payable on the basis of updated return. To this amount, we add interest under sections 234B, 234C, which is for default or deferment in respect of advance tax. And we don't add the same interest again, which has been paid in the earlier return. So at the time of self-assessment. So we reduce this 234B, 234C by interest paid in the earlier return, and the balance is what we add here. Now note that we don't add interest under section 234A for default in furnishing of return because the original return has already been furnished either as a regular, belated or revised return. So 234A would have been paid at that time. Similarly, 234F would also have been paid at that time because it is for default in furnishing return of income. So that's why we don't add 234A interest and 234F fees again here. So we only add interest under 234B and 234C. Finally, we add the amount of additional income tax, and that gives us the amount which is payable before furnishing the updated return. Now, in both the situations, you would have noted that towards the end, we add something called as the additional income tax. So how is this additional income tax computed? What is the timeline for furnishing of updated return? End of the assessment year, and updated return needs to be furnished within 24 months from the end of the assessment year. That means within 2 years after the end of the assessment year. So this is 12-month period and this is 12-month period, total of 24 months. Now, if the updated return is furnished before completion of 12 months from the end of the relevant assessment year, that means within this particular time, then what is the amount of additional income tax? We aggregate what? We aggregate the tax payable, which includes surcharge and cess, and interest payable. And then we compute 25% of that aggregate. So 25% of tax plus interest in both situations 1 and 2 above. So in situation 1, tax payable plus interest payable. Fees is not supposed to be included, please note. So tax plus interest. Similarly, in situation 2 also, tax payable on the basis of updated return, and then we add interest under 234B and C, so tax plus interest. So additional income tax is 25% of tax plus interest, where the updated return is furnished within the first 12 months from the end of the assessment year. But if updated return is furnished after 12 months but before 24 months, that means within this period, then the additional income tax percentage is increased from 25% to 50% of aggregate of tax and interest.